We got some certainty this week on how far the Fed was willing to move interest rates in order to tame inflation. And we had a couple of days this week after that that looked like a Jekyll and Hyde kind of scenario where the markets went up tremendously on one day just after the meeting, and the very next day went down significantly. So today we're going to look at what all has gone on in the market and determine whether we think a recession's coming. And if it is, what do we as dividend growth investors do? How do we handle that? Secondly, we're going to talk about the portfolio and see the impact of the week on the return of the portfolio. And then lastly, we're going to do a quick reassessment of Verizon. So if you're interested in seeing what all went on in the market this week, as well as its impact on the portfolio and a reassessment of Verizon, stay tuned. Hey everybody, Kevin Burgess back again with another video. This week we're going to look at the economy and where we think this economy is going, and what does the Fed movement have to do with the way we invest as dividend growth investors. There's a lot of hype out there right now, and so I thought it would be helpful to kind of look at some of that hype, read through that hype, and then determine what we need to do as investors. The second thing we're going to do is look at the impact of the week on the portfolio, and I think you'll be a little surprised at how that turned out. And lastly, we're going to take a look at Verizon. Verizon has given a 2022 outlook that's a little bit subpar, and so the question is, should we continue to invest in Verizon? It's been beaten down pretty much lately, and so the question is, should we stay in it? If you like the content in this video, I would appreciate it if you give it a thumbs up. It lets people know that the content in this video is good and meaningful and worthwhile. And also, if you enjoy talking about dividend stocks, consider subscribing to the channel. That's what we talk about here, is about the dividend stocks, dividend growth investing, and how we should position our portfolios moving forward. So with that said, let's get started. So let's take a look at what all went on this week. The first clip I'd like to show you is of Jerome Powell and his press conference after the Fed move this week.
Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
So in response to the Fed's move this week, I want you to hear how the idea of certainty kind of took over the market on Tuesday.
The 75 seems for real off the table, at least at the coming two meetings. And what the market loves always, Scott, you know this, everybody that's a frequent watcher of CNBC knows, they want certainty.
We now know what we're dealing with over the summer. We've got 250s pretty much locked in. We know what an aggressive policy response to this inflation outcome looks like. And a lot of us didn't know exactly what that was. The committee had to debate that. They debated it. They came up with a unanimous decision. I think that's important. There's not a lot of dissents. They're going to go pretty strong, but the market was pricing in the risk of something stronger. And
Gundlach knows a big market moment as well as anybody, and he knew that was the moment too when Leisman asked that question to the Fed chair, and the Fed chair said no. 75 basis points not on the table. We're looking at 50 for the next couple of meetings.
Yeah, I think that's right, Scott. And, you know, you found out today what the market was most fearful of. And it turns out it was not inflation. It was the Fed going crazy in the short term.
And the next day, the market went down. Then the talking heads began to talk about recession and whether we should see a recession soon in the market. Here's a couple of clips on that.
Let's bring in JP Morgan chief U.S. economist Michael Feroli. Feroli and Santoli. I'll start with you, Michael Feroli, which is, you know, it's hard to imagine that we're having conversations about a recession when we're adding in a tight jobs market more than 400,000 jobs and an unemployment rate at 3.6%. So how do you square that?
So I think the recession, at least as I understand it, the recession narrative or discussion is really about perhaps next year, not about next quarter. I think most people recognize that the momentum in the economy right now is pretty favorable. As you mentioned, the jobs number looking very timely and looking very strong. But as we see these financial conditions tighten, many of what you just talked about, stocks down, rates up, dollar way up, over time, if this continues, then you set yourself up for a scenario where maybe, a few quarters down the line, recession becomes more of a possibility. But again, as I understand it, I don't think it's a near-term concern, at least not for me, but rather something as you look out to next year becomes a little more of a real possibility.
Do you see a recession in the next 12 to 18 months, Mark?
Well, I think the economy is going to avoid a recession. If it's going to be, close call. I mean, I think probabilities of recession are awfully high over the next 12 to 24 months. With inflation as high as it is, and the Fed trying to calibrate things in this very difficult environment, you got two major supply shocks out there still hurting the global economy: the pandemic and the Russian invasion. So recession risks are awfully high here. But I think we'll be able to navigate through. I don't think the stock market at this point is saying recession. I don't think that's what it's saying. It's saying, hey, look, interest rates are normalizing. They're going up. We got to adjust to that. And we need a slower growing economy.
So with all the discussion on recession, the question is, what should we do? Where should we hide? Where should we go to invest our money?
So the question I keep coming back to, as we see these incredible moves on a daily, even intraday basis, Manish, is how should investors be positioned here? I mean, the moves are so dramatic. Get out of equities altogether, park your money just into cash for now. Bonds, which are going down almost, or had been almost simultaneously with equities. I mean, what do you do?
No, it's a tough call, and there's almost nowhere to hide. And even if you look back at the 70s and 80s, the total returns for equities were not bad, but they were very close to what cash delivered for you. So ultimately, I think cash is probably the safest place right now.
And in the midst of all of this angst about the market, there was one voice of reason that I heard, and I want to play that for you.
All right. Karen, not to get wonky and weird, but at the end of the day, a stock price is simply the measure of the cash available after operating expenses and debt service. And then you sort of divvy that up and give it amongst the shareholders. I'm being overly simplistic, but I think Mark made a good point that if you think earnings have peaked, what else is there to look forward to? And I think maybe the market is telling us that story.
I guess, although I think all stocks are not the same, right? So I think there are some where earnings have peaked, and I certainly think the ones who are, pandemic beneficiaries, those earnings may have peaked. Certainly those multiples have peaked. But there are some that have just been thrown out with the bathwater.
So what does all this mean? How should this impact us as dividend growth investors? I would say this. I would say that as dividend growth investors, we invest in companies, not in markets. We look for quality companies who have good valuations, and we invest for the long term. So as dividend growth investors, should I be asking myself where the market's going tomorrow, or should I be asking myself where the market's going to go in 3 to 5 years? I would argue that we as dividend growth investors should focus on a 3 to 5 year, even 10-year outlook. And this will lead us to make decisions that for a week or 2 weeks or 6 months might not seem to be the best decision, but in the long term will set us up for success. And why will it set us up for success? Because we invest in companies, not in the market. I think it's really interesting how the television personalities kind of give the market these anthropomorphic terms, right? They make it seem like it is a person. So what does the market think about this? Or what does the market say about this? Or what is the market saying? Well, the market doesn't say anything. The market is only a reaction of all of the investing that's going on within it. So let's lose this idea of the market being its own person. And let's remember that the market is a collection of companies. But at the end of the day, I'm looking at whether I want to actually hold the stock in a company rather than whether I think the market's going to go down tomorrow. I did a video on market timing, and I will put that at the end of this video in the end screen so that you can listen to that. It's really interesting how market timing is a no-win game. So to time the market is a no-win. So as dividend growth investors, Let's stay invested. Let's pick up companies that have good valuation, and let's look for the long term. The next item on our agenda is the portfolio update. And I am pleased to say that the portfolio went up $30,000 this week. I did fund my normal $7,300 that I put in on a monthly basis. The market change was $22,688.65. Even after all of the noise, the portfolio went up 2.8% versus the S&P that went down 0.2%. And then on a year-to-date basis, we are again back in the green, going up 2.8% this week. We are up 0.4% on the year, while the S&P 500 is down 14% on the year. So very pleased with the portfolio, have been pleased with it all year. I did get $545 worth of dividends this week, $369.80 of that coming out of the dividend yield account. So overall, very positive, very strong performance from the portfolio this week. And compared to market on a year-to-date basis, we are up 14.4% versus the market. So let's finish up talking about Verizon. I put a question out in my community about whether people preferred AT&T or Verizon or both or neither. And the interesting thing is that 61% of you prefer Verizon, only 9% prefer AT&T. We had 18% who prefer both and 13% who prefer neither. Now, this is not a scientific survey. There's 80 votes here, but I think it does tell the story that there's a lot of people who are more geared toward Verizon than AT&T. So let's take a look at Verizon. You can see that over the last year, Verizon is down 17.8%. Year to date, it's down almost 8%. And then the last 5 days, it's actually up a little bit at 3.5%. So is Verizon worth investing in? Well, let's take a look at what Morningstar says. Morningstar says Verizon offers a cautious 2022 outlook, but our long-term view is unchanged. And as dividend growth investors, we look at the long term. So when we look at their write-up here, the thing that is most important is we don't believe Verizon's 2022 outlook has much bearing on its longer-term future. Our fair value estimate remains $59, leaving the shares modestly undervalued. So according to Morningstar, their value is $59 with a close at $48.27. That's about an 18% discount. So it seems to be a worthwhile buy here for me. Then I move on to a report that came out this week from Simply Safe Dividends, and they basically said Verizon's fundamentals appear sturdy despite slumping stock price. They reaffirmed the very safe dividend rating of 87 out of 99. Now, this dividend yield of 5.3% is very attractive to me in my yield account. It only grows 2%, so if you're looking for growth, this is not the right stock for you. But I am looking for yield in part of my portfolio. So 5.3% is a really nice yield. So I think in this account for me, because I am retired and I'm beginning to look for streams of income, having a 5.3% yield that grows at 2% is pretty attractive to me. So I'm going to continue focusing on Verizon in my portfolio. I wouldn't be surprised if I picked some up this week at these low prices. So with all of that, I think it makes sense for us as dividend growth investors to continue investing in companies, not in the market, to continue our analysis, to trust our due diligence, and to end up with companies that we want to hold for longer periods of time. So like I mentioned earlier, I'm going to put the market timing video here, and then I'm going to let YouTube pick a good video for you here. And then with that, I'm going to get out of your hair and I'll see you on the next video.